Welcome to TS Lombard. In our note, we take a look at Chair Yellen's press conference and the FOMC statement and look at it in juxtaposition with the data that we got yesterday on retail sales, CPI, and how it works with our own outlook. Starting with Chair Yellen's comments, they were perceived by the market as being actually rather dovish in the sense that the market was beginning to anticipate a much steeper pace of tightening by the Fed. Now, we happen to think that the market was moving in the direction that was correct, that the economy and attendant inflation will be strong enough to generate many more increases in the federal funds rate than is currently being priced. But Chair Yellen poured a little cold water on that by telling people that, well, 2 more is probably about right. And their dot plots, the now infamous dot plots, didn't even move. From our perspective, this has a lot more to do with keeping the markets in line with their own presumptions about growth rather than imposing the Fed's views on them. They did that in 2014 and 2015, and the result was a slower economy. Chair Yellen and the Fed really does not want to repeat that mistake again. So they'll talk a dovish game, even though they themselves might privately believe that they're going to need more tightenings than the market is currently pricing. When we look inside the CPI and retail sales numbers, even though retail sales was soft for February, in truth, when we look inside the data, we find some rather strong underlying trends to support our view that as the year goes on, especially towards the second half of the year, we will begin to see the stronger growth and higher inflation that is going to cause the Fed to play a little bit of catch-up in terms of what they are doing in terms of setting policy. And by a year's time, our guess is that we'll be at probably about 150 basis points higher in the funds rate.